Okay, so you want to own a storage facility. Buy a plot of land somewhere off the highway, put up a few hundred metal doors, and just collect rent. No tenants calling at midnight about a broken water heater. No renovations between guests. No staff standing behind a counter all day. Just steel boxes, a keypad gate, and a stack of checks that show up whether you do anything or not. That's the pitch. That's the entire passive income fantasy the gurus have been selling for a decade. Buy some land, put up some metal, retire early, check occupancy from your phone while the rest of the world works. Here's the problem. The word passive is doing an enormous amount of work in that sentence, and almost none of it is true. Self-storage isn't a real estate business that happens to be easy. It's a collections business that happens to have a gate code. And by the end of this, you'll understand exactly why the biggest operators in this industry secretly want you to forget your unit exists. We'll get to why in a minute. First, let's talk about what you're actually buying. Because storage facility is not one business. It's several wearing the same orange roll-up door. At the top of the market sit the national REITs, Public Storage, Extra Space Storage, CubeSmart, Life Storage before it was absorbed, names you've probably driven past 100 times without registering. These operators run thousands of locations, price using real-time revenue management software that adjusts rent almost daily based on occupancy within a 5-mile radius. And they've spent the last 2 decades buying up independent operators one acquisition at a time rather than building from the ground up. Below that sits the regional operator, someone running 5 to 20 facilities across a single metro area, big enough to negotiate decent group insurance and financing terms, small enough that a single bad lease-up can still genuinely hurt. Below that, the single-site independent facility, the one most first-time buyers actually picture in their head, usually a few hundred units on a single parcel, run by an owner who checks in a couple times a week and handles move-ins over the phone. And then there's the specialty tier, an entirely different animal, climate-controlled facilities built for wine collections, document archives and antiques, boat and RV storage yards that need acreage rather than square footage, and the newer storage condo model, where individual units get sold outright to buyers like miniature warehouses instead of rented month to month. Each of these is a different bet on the same underlying question. Do you compete on volume and pricing software the way the REITs do? Or do you compete on being the only decent option in a town with nothing else? That single decision shapes every other number in this business. Now here's where the naive mental model starts to break down. People assume the expensive part is the land, maybe the steel buildings themselves. It is it. The expensive part is turning an empty lot into a legally permitted, fully fenced, fire code compliant facility that a city actually lets you operate, and that process starts long before construction. Zoning is the first wall most new owners hit, and it's a bigger one than people expect. Storage facilities get fought by neighborhood associations almost everywhere, because nobody wants a warehouse full of strangers' belongings visible from their kitchen window, and city councils know it. Getting a parcel rezoned or conditionally permitted for self-storage use can take 12 to 24 months and tens of thousands of dollars in legal, engineering, and consulting fees before a single shovel touches the dirt. Land itself varies wildly depending on where you're building. A rural parcel off a state highway might run a few dollars per square foot. A parcel in a growing suburban corridor, the kind of location that actually supports strong rental rates, can run considerably more. And self-storage developers routinely compete with retail and multifamily developers for the exact same commercially zoned land, which pushes acquisition costs up further in markets that are already expensive. Once you clear zoning, construction costs for a standard single-story drive-up facility run somewhere between $40 and $70 per square foot, depending on region and materials. A climate-controlled multi-story facility, the kind that competes in dense urban markets where drive-up land simply isn't available, runs $70 to $120 per square foot once you add insulated walls, HVAC systems large enough to hold humidity steady across an entire building around the clock, and freight elevators rated for moving furniture and appliances rather than people. A mid-size facility of around 80,000 rentable square feet can land anywhere from $4 to $9 million, all in land, construction, permitting, and site work before you've rented a single unit. Add a keypad gate system, individual unit door alarms, a full perimeter camera network, and fencing. And security infrastructure alone can run $100,000 to $300,000 depending on facility size and how urban the location is. None of this shows up in the buy land, put up metal boxes fantasy. All of it shows up on the construction loan, and the costs don't stop once the ribbon gets cut. This is the part almost nobody budgets for correctly. Property taxes get reassessed the moment a municipality sees a finished commercial facility sitting where an empty lotus to be, and that reassessment can add tens of thousands of dollars a year in tax liability that didn't exist during the pre-construction pro forma. Commercial property insurance for a facility holding an unknown mix of other people's belongings, everything from furniture to, occasionally, things tenants aren't supposed to store at all, runs meaningfully higher than a comparable retail or office building, and premiums have climbed sharply in regions exposed to flooding, wildfire, or severe storms, which happen to be exactly the regions where a lot of new self-storage development has concentrated. Then there's lead generation. Very few tenants simply drive past and walk in anymore. Most discover a facility through Google search ads or through aggregator platforms that list available units across multiple operators and take a referral fee, often a meaningful percentage of the first month's rent, for every tenant they send your way. A facility that isn't paying attention to its marketing spend can watch a third or more of a new tenant's entire first-year revenue evaporate straight into customer acquisition costs before the unit ever turns a genuine profit. Here's the trap that catches almost every first-time storage buyer, and it's the one that turns a good pro forma into a bad one. You don't just build for today's demand, you build for a market that can change underneath you in 18 months. Self-storage development runs in waves, the same way apartment construction does. A developer sees strong occupancy and rising rents in a metro area, breaks ground, and by the time construction finishes 2 years later, 3 or 4 other developers who saw the exact same public data have finished their facilities too, all competing for the same pool of renters at the same time. Industry data haystacked metro areas where new self-storage supply grew by more than 20% in a single 3-year window, only for rental rates across the entire market to drop 10 to 15%, as all that new square footage chased the same tenants. You can build the nicest, newest facility on the street and still get crushed by a rate war you had no way of predicting when you signed the construction loan 2 years earlier. So, how does anyone actually make money doing this? This is where the real mechanism of the business reveals itself, and it has almost nothing to do with the monthly rent check you'd expect walking in. Picture 2 tenants. One moves in, fills their unit with furniture from an apartment move, and comes back every couple of months to grab a box or swap out seasonal gear. The other signs up during a divorce, a move, or a death in the family, throws in a mattress and some boxes, and then simply stops thinking about it entirely. Which of those 2 tenants is more profitable to the facility? The second one, and it isn't close. Industry surveys of self-storage tenants consistently find that a large share haven't physically visited their unit in over a year. Every visit from the first tenant costs the facility something. Wear on the gate mechanism, staff time if there's a front desk, and a slightly higher chance they actually notice a rate increase and shop around for somewhere cheaper. The tenant who forgot they even rent a unit costs the facility almost nothing, while their monthly payment keeps arriving on autopay like clockwork. This is why storage REITs have built entire pricing algorithms around a strategy the industry politely calls asking rate versus achieved rate. New tenants get a low introductory rate specifically to fill the unit fast, sometimes discounted 50% or more for the first month or 2. Existing tenants, especially the quiet ones who never call to negotiate, get rate increases of 8 to 15% every year, sometimes considerably more, because the operator knows the psychological and logistical Cost of moving a unit full of stuff is far higher than the cost of just paying the increase and grumbling about it. The forgotten unit isn't a failure of the business model. It is the business model, and this is the exact same mechanic that keeps a gym profitable off members who never show up. Different industry, identical math. And when a tenant doesn't pay at all, that's not purely a loss either. This is the mechanism almost nobody outside the industry understands, and it's the one I promised we'd get back to. Nearly every state has a self-storage lien law that lets facility owners auction off the contents of a unit after tenant falls sufficiently behind, typically somewhere between 30 and 90 days past due depending on the state's specific statute. Before that auction ever happens, the facility has already collected late fees, often $20 to $50 per missed payment, and in many states can tack lien processing and notice fees directly onto the delinquent balance. Once the lien threshold is crossed, the unit gets auctioned, sometimes live at the facility, increasingly through apps built specifically for storage auctions that let buyers bid sight unseen based on a single photo through the unit's roll-up door. Whatever the contents sell for gets applied against the unpaid rent and fees. In most states, anything left over technically belongs to the former tenant, though very few of them ever come forward to claim it. The facility recovers its losses, clears the unit, and rents it out again, sometimes within the same week. Delinquency isn't purely a cost center in this business. It's a built-in recovery mechanism most other real estate asset classes simply don't have, and it's part of why storage has historically weathered recessions better than office or retail. When people lose their homes or downsize suddenly, storage demand often goes up, not down. There's a second hidden revenue stream stacked directly on top of this, and it's enormous relative to how little attention it gets from anyone outside the industry. Tenant insurance, frequently sold as a mandatory protection plan, bundled straight into the lease agreement at move-in. Most facilities require tenants to either prove they already carry insurance covering their stored belongings, usually through a homeowner's or renter's policy rider, or purchase the facility's own protection plan, typically $10 to $25 a month depending on the coverage tier. The facility's actual cost to provide this coverage, since it's frequently underwritten through a captive or reinsurance arrangement set up specifically for this purpose, is a small fraction of what tenants actually pay for it. Attach rates on these protection plans can run well above 70% of all tenants at a well-run facility, and industry analysts have repeatedly pointed to ancillary revenue like this: protection plans, late fees, lock sales at the counter, moving truck rental commissions, retail box and packing supply sales, as accounting for a meaningful double-digit percentage of a facility's total profit, even though almost none of it appears in how the business gets marketed to prospective renters searching for cheap storage near me. Of course, none of this means the business is safe, and it's worth looking at what happens when the math breaks down at scale. Look at the storage oversupply cycles that hit fast-growing Sunbelt metros over the past several years. Markets across parts of Texas and Florida saw such aggressive new construction, fueled by cheap financing and REIT expansion targets, that some operators had to slash asking rents by 20% or more just to hit occupancy targets on brand new facilities. Operators who'd underwritten their construction loans assuming steady, uninterrupted rent growth suddenly found themselves unable to cover debt service on buildings that looked fully leased on a map but were actually bleeding cash after aggressive move-in discounts. Storage isn't immune to the same boom-bust cycle that's wrecked other real estate categories before it. It just happens more quietly because nobody writes a headline about a half-full storage facility the way they write one about a bankrupt hotel chain or a collapsed shopping mall. Even at the very top of the industry, the national REITs have gone through their own reckonings. Public storage grew for decades primarily by acquiring smaller independent operators rather than building from scratch, a strategy that only works as long as acquisition prices stay comfortably below what the underlying cash flow can support. When capital got more expensive and cap rates compressed industry-wide in recent years, several of the larger consolidation deals in this space came under scrutiny for whether the acquiring companies had overpaid for facilities in markets that were already showing early warning signs of oversupply. U-Haul's parent company has taken the opposite bet, expanding aggressively into self-storage using existing rental truck locations and real estate it already owned, effectively vertical integrating the move-in and the storage unit into a single customer relationship. Note very expansion strategy in this industry succeeds equally, and the ones that get punished hardest are the operators who confused a rising market for a permanent one. The lesson repeats across every version of this channel. A parking lot full of orange doors and a keypad gate that always seems busy tells you nothing, on its own, about whether the underlying debt structure can survive a bad 2 years. So, how does a storage facility actually make money in plain mechanical terms? The core engine is simple. Monthly rent per square foot times occupied square footage minus fixed costs. A typical stabilized facility charges somewhere between $12 and $20 per square foot per year in most mid-size markets, with climate-controlled and dense urban facilities pushing well above that range. Let's run the actual numbers on an 80,000 rentable square foot facility. Say it achieves an average rate of $14 per square foot annually once you blend climate-controlled and standard units together. Fully occupied, that facility generates $1.12 million a year in gross rental revenue. Now add fixed annual costs, debt service on the construction loan, property tax, insurance, a small maintenance and management staff, marketing spend of around $900,000 a year. To simply break even, the facility needs to cover that $100,000 cost against its rental income, which works out to somewhere around 65 to 75% physical occupancy depending on exactly what rate it's actually achieving once move-in discounts and delinquency are factored in. Below that occupancy threshold, the facility loses money every single month, quietly, the same way a gym below its break-even membership count does. Above it, since the marginal cost of an occupied unit is close to zero, no extra water, no extra staffing per tenant, no meaningful wear beyond a bit more traffic through the gate. Additional occupancy above break-even is almost pure profit flowing straight to the bottom line. That's the good news. Here's the volatility that comes right behind it. New facilities typically take 24 to 36 months to reach stabilized occupancy in the 85 to 90% range, and every single one of those months burns through the cash reserve set aside before opening. If a competitor breaks ground nearby during that exact lease-up window, which happens constantly in growing metros because everyone is reading the same market data at the same time, the runway can run out before the facility ever crosses into genuine profitability. Now, let's put both versions of this business side by side, because that's where the two very different outcomes reveal themselves. In the optimistic scenario, you picked a market with genuine population growth and limited new competing supply, hit stabilized occupancy on schedule around month 30, kept your rate increases aggressive on the quiet, non-shopping tenants who make up the bulk of your roster, and layered in a healthy protection plan attach rate above 70%. Under those conditions, a mid-size independent facility can generate somewhere between $1 and $2 million a year in revenue with a net operating margin of 40 to 50%, extraordinarily high for a real estate asset class, which can translate into an owner's annual cash flow somewhere in the $300,000 to $500,000 range once debt service is fully covered. In the realistic scenario, 2 or 3 entirely ordinary things go wrong at once, none of them exotic. A competing facility opens 2 miles away right in the middle of your lease-up, and both properties end up in a rate war that drops achieved rents by 15% industry-wide. Lease-up itself takes 6 months longer than the original pro forma projected, because the local economy slows down right when you needed new tenants walking in. Delinquency runs a few percentage points above forecast because a recession hits the exact metro you built in, right on schedule with the broader economic cycle. Under those conditions, that same facility can slide from a 45% margin into a 20% margin. And depending on how aggressively the construction was financed, an owner can go from comfortable, genuinely passive feeling cash flow to barely scraping together the monthly loan payment. The difference between those two outcomes on a single mid-size facility can be several $100,000 in a single year. And almost none of that swing shows up as a dramatic, visible event. No fire, no scandal, no headline. Just a slightly higher vacancy rate, a slightly longer lease-up period, and a slightly heavier debt load. Compounding, quietly, month after month until the number at the bottom of the spreadsheet looks nothing like the plan the owner walked in with. So if you do decide to build or buy a storage facility, remember the one thing that actually determines whether you succeed. It was never really about how empty the lot looks from the road, or how little you personally have to show up. Picture that same owner again, checking the occupancy dashboard from the beach, the fantasy that started this whole video. What they're actually looking at isn't a passive asset quietly collecting rent while they do nothing. It's a live feed of delinquency reports, auto-renewing rate increases on tenants who will never call to complain, and lien auctions running quietly in the background, an entire system engineered to profit from the fact that somewhere out there, a few hundred people have simply forgotten what they're paying for every month. The app makes it look passive. It isn't. It's a business built almost entirely on human procrastination, on the gap between what people intend to deal with and what they actually get around to. And the owners who understand that difference are the ones who quietly get rich off a gate that most of their tenants will never walk back through.